Welcome to Chit Chat Stocks. Today we've got our Power Hour episode, and we are joined by, well, I should introduce myself here. I'm one of your hosts, Ryan Henderson, and I'm joined by Brett Schaefer as always. But we have a special guest, recurring guest. I believe you've been on the, I don't even know how many times you've been on the show, but we are joined by Jason Hall, host of the Investing Unscripted podcast. Jason, how are you this morning?
I'm good. I want to say too, I appreciate you calling me a special guest. I'm more of an adequate guest, I think, probably. But yeah, I've been on a lot of times and I'm always happy to come on. It's a lot of fun.
Nice. Yes. Well, we've got plenty of topics for this week, and we've got a big announcement from a company that you follow very closely. So I'm excited to dig into that. But before we get started, I want to talk about one of our friends. I'm going to let you in on a little secret, Chit Chat listeners. You know how much you hate fees on options trading? You know how these fees can be as high as $1 per contract? Public.com has just launched a first of its kind options rebate program that can save you money in a sleek, modern trading experience. Public.com options traders have zero commission fees, zero per contract fees, and trading rebates of up to 18 cents per contract, depending on the number of referrals you make. That's right. Public.com will give you back money on every options contract you trade, which can save you hundreds or even thousands of dollars per year as an active options trader. It's simple. Public allows you to spend less and get more back on your options trade. Why would you go anywhere else? Check it out for yourself and start saving on your options trades at public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures in the podcast description. U.S. members only. Let's get right into things. I think we should start with the Boston Omaha news. Is that okay with you, Brett?
Yeah. That's good with me. Yeah, I added it in there. I especially added it in there because I know Jason has followed the company for a long time, and yeah, huge news. Who wants to take it? Should I read the summary of what happened?
Yeah, Brett, you give the basics, and then we'll cue in Jason for his expert take.
Yeah, I don't know how much he likes you called him an expert over and over, but I agree with you. All right,
I'm a special
Let's just read
expert.
some quotes from the press release.
Let's get this clear. Special expert.
Yeah, we're all just, as your show says, doing it in an unscripted manner. All right, Let's read the press release. So, Boston Omaha announced that Alex Rozek, co-CEO and co-chair, has left the company effective as of May 9th. So now,
which was the day after, or the day before the release came out.
Yeah, and they said to pursue new entrepreneurial opportunities. Adam Peterson will continue to lead the company as chair and CEO. Other quote here, Boston Omaha is committed to focusing on our goals of expanding margins in our existing businesses, reinvesting cash flows into profitable business opportunities, expanding our investments in billboards, surety insurance, and fiber to the home, as has been the case since Boston Omaha was founded. Allocating capital to its best and highest use within our opportunity set will be the guiding principle. One thing, Jason, do you think you could turn your mic up a tad? I think you're a little quieter than Ryan there. Maybe a couple notches, honestly.
How's that? Is that better?
Maybe I'm just shouting. Is
that good?
No, I think yeah, Ryan does talk a little loud, but we'll try to make it.
How's that? Is that better? Let me get my mic
That's
a little
better.
Higher. Here we go.
Yeah, and maybe get the mic there. All right. I think we're good. I read the quote there, Jason. You'd followed this company or have followed this company. We'll let you give your thoughts first.
Yeah. So just for anybody that's not real familiar with Boston Omaha, the basic thesis here is you've got two young, heavily skin in the game investors. These guys were in their 30s when they founded the company. It's been about 9 years ago since I believe Boston Omaha went public. Co-CEOs, the idea is skilled capital allocators building out these operating subsidiaries that they have, surety insurance, which is like if you've ever had like a skilled tradesperson come in your home and you want somebody that's bonded, right? So they're insured against like theft or damage, that kind of stuff. That's what surety insurance is. They have a billboards business, and more recently they've started a fiber optic cable business as well. The idea has been that they were going to allocate capital one of two ways, right? They were going to take these core businesses and grow them, right? Allocate capital into expanding them, buy more billboards, acquire more insurance agencies, move into more neighborhoods, mostly like new build neighborhoods with their fiber business, but also go out there and shop for other opportunities. If you think about some of their successes, their big wins, Dreamfinder Homes, right? They led that company public. They were a large public market investor. They completely exited that position some time ago. The stocks actually continued to run higher, but they sold. They made a lot of money. They wanted that money to go after other things, like starting up the fiber business, right? Sky Harbor is a company that they were a pre-IPO investor in that's done really well. They still have a position there in that business. So again, that's the idea, is it's like the whole baby Berkshire, right? So that's kind of, that gets thrown around. There's lots of those companies. And oh, by the way, Alex Rozek happens to be the great nephew of Warren Buffett, right? So, this is really the next Berkshire Hathaway, right? Well, apparently not, because that guy's out the door. Questions at this point? I keep going.
I'll intervene here.
Yeah.
I think we actually have I should say first, I keep track of the comments on the live stream. We do have your co-host at Investing Unscripted, Jeff, giving you some trash talk in the comments.
Dear God.
That 1789 called and they want their hairstyle back, which I gotta say it's not bad. That's not a bad one.
Touche. Jeff, go back to work, ruining America's youth.
Okay, let's on Alex Rozek.
Yes.
What did you think of? Did you ever have any shaky feelings about either of them prior to this announcement?
So I think the bottom line is, if you look at the results of the business, besides a couple of big wins in public markets, you look at the operating results, they haven't been great, right? The economic returns of the operating businesses haven't been good. They generate a little bit of positive cash flow. They just reported Q1. They just dropped that release yesterday, I believe, maybe the day before. But generally report operating losses. Now, part of it too, you can say, well, they're scaling up, right? So they're adding a lot of capital assets. So there's depreciation costs that are growing maybe faster than they can scale those assets. You can kind of make that argument. But the economic returns just haven't been good. Again, except for a couple of those big hits. And my position has been evolving on this. I own some Boston Omaha. It's a relatively small position. It's less than 2% of my cost basis, so it's not that big. I think this is a good time for investors just to kind of stop and think, when you have this kind of change. Because my initial thought had been, so Rozek's out, the economic returns haven't been good. Maybe this is good because now you have the entrepreneur leaving, right? That's like Peterson was commented that he's an entrepreneur, that Rozek's an entrepreneur at heart. Really, if you start looking at the business, those were actually the things that have done well. The things that Peterson is saying, we're going to double down and we're going to focus on our core businesses, allocate capital from cash flows back into those core businesses and focus there. That's good because they haven't done well, but they haven't done well, right? Yeah. So I've kind of struggled with this, and I think it's one of those things where I get it why Rozek has left and why Peterson has remained, because Rozek, again, seems to be the one that's the creative, that's out there. He's a hunter, right? He's looking for those opportunities. And it seems like Peterson's maybe more the farmer, where he's kind of taking care of the existing assets and trying to optimize them to generate as much yield and results as you can from them. So now here's his opportunity to do it, right? And for Rozek, it made sense to leave because, well, the operating business wasn't generating maybe the cash flows that Rozek would want to see. And then from a market value, it's consistently over the past year or so traded for a discount to book value, which means your equity's not a premium asset to do like secondary offerings to raise capital. Interest rates have gone up. So debt yield is debt's maybe not the best way when you're not a AAA rated business to get capital, right? So all of a sudden it's not an attractive asset for the hunter to use as a leverage tool. And then the other reality too is thinking about Peterson. They both owned a similar amount of like the super voting non-trading shares. They had a similar amount. Peterson owned like 0.3% more. Like they basically were 50-50 there. But Peterson also owns a lot of the common float. So his economic interest in the business was actually a lot larger than Rozek's. So that was another thing that I'm sure came into play, is that, the person with the bigger stake in the business, and plus also wants to focus on what the core business is the one that wants to stay. It doesn't make sense for Rozek to stay if this is not his style of investing and the assets are not going to support what he wants to do. So here we are.
Yeah,
Okay.
I think a couple things there. I will say, one, I can understand why the stock's done what it's done. Like, there's no reason for any investor that's not maybe even analyst, maybe even someone that's a little shorter term, to say, why should the stock be higher? Because as you said, the operating performance of these businesses, well, not terrible. There's nothing to get excited about at this moment. Second, I can understand people pitching it today as sort of a turnaround play. As you mentioned, it is fairly cheap. But I can also, and I read your newsletter, I believe it was the Investing Unscripted one you guys do, where you said that you have to be at least a little bit concerned for yourself and try to look a little introspectively about moving the goalpost. Do you maybe want to talk about that? Because I thought this is a perfect situation for that.
Yeah, I think that's the case. Certainly for existing investors, and we always do that when we have a business that we've taken a stake in. It's human nature. We're going to defend like our turf, right? And if something fundamentally changes with the business, it's impossible to be objective and say, okay, that's a bad move. We're almost always going to be inclined to defend whatever has changed, because we're invested in it, right? And that's how humans are wired to do it. So there's I've seen a ton on Twitter over the past week since the announcement came out that, oh yeah, Rozek really wasn't very good anyway. Peterson's the better capital allocator. This is a stronger business. This is good news. BS, guys. You're just saying that because
you don't know. You don't know that.
Right. We don't know. Ryan, you've got some, jump in, bud.
Okay. So I do have, we went to a Boston Omaha shareholder meeting, and I kind of got the sense throughout that meeting, just little, I don't know, social cues where sometimes Rozek would speak on subjects and you'd see Peterson almost visibly kind of get, I don't know, nervous in a way, like he didn't want Rozek to speak on certain topics. And I at first I didn't read that much.
Was this last year's meeting?
No, this was
year before.
I think 3
years ago. So it was
ago?
a while
Okay,
back.
wow.
Lots happened since then.
Yeah.
But I didn't read too much into it. It did feel a little weird. It didn't feel like they were necessarily best friends. Then they did get a huge pay package at one point, which seemed a little weird for two CEOs that own a lot of the business. And then this was probably the thing that irked me the most. There have been a lot of articles written that say Warren Buffett's grandnephew is the next big thing. And some of that is stuff he can't control, right? I mean, if someone wants to write that because the information's out there, that's fine. But here's an article from that Sky Harbor Group reposted. Business Insider, Warren Buffett's great nephew appears to share the billionaire's investors' taste in business appetite for acquisitions. He could have prevented Sky Harbor Group from reposting.
Alex Rozek's on the board at Sky Harbor, and Boston Omaha chose to ask him to remain on Sky Harbor's board as the Boston Omaha representative. So that was probably his idea, I would say.
I don't know if it was necessarily his idea to repost it, but he could have easily. Oh, to stay on Sky Harbor? What are you
his idea, like Sky Harbor was his idea.
Oh, no doubt about it. Like that investment, I'm sure.
Okay.
I'm sure it was. Yeah. Yeah.
But what I'm looking at here is them essentially making a press release about his association with Warren Buffett, which to me, it kind of felt like he liked the press he was getting from it. Maybe it was bringing them extra investors because they thought there was some gene in the Buffett family that allowed them to be superior capital allocators. Maybe there is, but I don't like when I see that kind of thing. And it felt like there were some red flags here that we could have detected.
I try to not read too much into that because there's certainly there's the case that he knew about it and wholeheartedly supported it or knew it was happening and didn't do anything to stop it. But there's also a possibility that he found out when a PR person forwarded to his email, like 2 hours later, and he called somebody up and he's like, what the F are you guys doing? We don't know. Right. So I try not to read too much of that. But I think the bigger thing for investors to think about is and one thing to kind of lean into the believing the press part, but maybe also just realizing, hey, as a company, Boston Omaha, we need to do a better job of talking to the investing public because they don't do calls, right? They don't even pre-announce. They don't say, we're going to release earnings on, May 15th. They just drop the press release and the 10Q when they release it, right? I mean, so it's almost like they're trying to portray themselves as being like a Berkshire, because Berkshire does the same thing, right? They just release their earnings, and they just do it. They don't hold calls or that kind of stuff. Interestingly enough, over the past 4 or 5 months, Rozek has been more actively talking to the investing public. A colleague and a friend of ours, Matt Frankel, was fortunate enough to have a couple of conversations with him, and he's got a pretty big stake in the business. So there's clearly and I think this is the big thing. There's clearly been some sort of a divergence of approach, right? I think it's the capital allocation, number one. And then 1A, there have been some divergence of how do we need to present our company to the investing public to kind of have some influence on the narrative around our business, right? And it seems like that's been the biggest divergence, honestly, was the capital side because of everything that's happened with interest rates, probably more than anything. And the discount to book for the stock, combined with the operating results not being great, enough to really give them the highest credit rating to get the best rates on debt. I mean, they closed their asset management business earlier this year, right? So it was pretty clear outside capital was becoming less and less of a focus, and that's definitely going to affect somebody like Rozek, who is more the hunter. I think broadly. I know you guys, we need to move on here pretty quick, but this is the last thing I want to say. Anybody that's looking at this is a deep value play, I think we should be careful. I think it's probably undervalued just based on the quality of they're good assets. They're decent, but here's the one thing that can unplug it. What's the market cap today? $500 million, $600 million.
I'll get that for you right now.
Okay. Yeah. Pull that up.
On FinChat.
431 million.
Okay. Yeah. It has come down. So, okay. So
just below 14.
So, $182 million in, goodwill on the books, $182 million in goodwill. So you add that back in and you add that to the market cap and bring it up. And then all of a sudden you get closer to like a 10% premium to book value. Right.
Right.
So the market's clearly saying, we think you've overpaid for some stuff. Right. So, I mean, they're cash flowing assets though. So I don't think they're going to have to liquidate any of them. So you start carrying the value out over long term, it's probably below fair value. But that's my last thing is that don't have to rush into this as some deep value play, and the stock's going to pop quickly at some point.
Yeah. Okay. Final question.
Okay.
I'll answer it too. I'll ask both of you guys. Does the last year of events with Boston Omaha make you more confident as the company being a never sell in your portfolio, or less confident?
Less confident to neutral. There's a part of it that makes me potentially more confident because it does clarify exactly what they're going to do. And you have one voice coming from the CEO seat who's laser focused on the thing that is the detriment. But we don't know if the assets are the right quality, and we don't know that he is the right leader to be focused on allocating capital in that area. To find out. Ask me that question again in a year.
All right, Ryan.
So it's actually funny. I came away from that shareholder meeting that we went to thinking I kind of preferred Adam Peterson. I was also pretty happy when he was added to the Nelnet board. And it did kind of feel to me like Rozek was maybe the more promotional one, if we want to call it that. And I remember sitting down I went and got lunch with John Rotanti and Tim Byers, and we talked about Boston Omaha. And I said, I kind of have a bad feeling about them. Like there were some red flags. It was whether it was the social cues between Rozek and Peterson, the pay package that they got. I remember one of the answers he gave about the Allocations business at the shareholder meeting was a little concerning too. He's like, this is the perfect business. The only thing holding us back is, like he said, we have wonderful margins on it. The only thing holding us back is just the labor shortage right now. And I'm like, okay, why don't you just maybe contract the margins a bit and add some labor, or pay your labor more. But there was just a bunch of little yellow flags, if we want to call them that. And I said, and we sold our shares, or I sold my shares, and I didn't really want to be a part of it. So, and Tim said, whatever that feeling is, where you kind of, maybe there's some sort of distrust there, he said, really trust that feeling, because that's the stuff, like that gut feel matters a lot. And I thought it was kind of prescient. I thought it was a really good point from him, that if you start to get that tiny gut feeling that something's off, it's worth paying attention to.
Yeah, and even if it's not off, I guess this is a broader lesson for everyone. Even if everything was fine, there's a lot of pitches out there you can swing at. So i- I think it's better to be extra safe, and you can have some false positives there, but it helps you make sure that the real positives don't blow up your portfolio if you go crazy into a company like, say, Boston Omaha at $40, and now it's at 14, and it's a bit of an uncertain situation. That's not really where you want to be. I'll answer, I guess. I'm less confident slightly. I do agree with Ryan that I think Peterson is pretty sharp, so I don't, and the stock's cheap here, but the confusion, the seems to be disorganization from the company. It just doesn't inspire confidence from me that I should trust this executive team, even the whole team running this company, to generate value for me.
Last question on this. So I guess we didn't even mention this. Rozek's shares were purchased by the company, right?
Yeah. Yeah.
Would you characterize this as a fallout between the managers, Jason?
TBD. I don't know. I don't know.
Seems
Yeah,
like that
I
from the
agree. I agree
outside.
with Brett. I don't know if fallout is the right way. I mean, sure, to a certain degree. But I think that, that kind of assumes a certain amount of emotion. So I'm sure to some degree, yes. But I think the reality is just that structurally, Boston Omaha is not going to support somebody that wants to use outside capital as a growth engine for acquisitions, right? It's not the right tool for that anymore. So it made sense for Rozek to move on.
All right, let's hit another topic. This one I think would be fun, although it might have just been a flash in the pan. Roaring Kitty is back. The meme stocks are back, or we're back for a couple days here. I'll get into some of the numbers. We can kind of look at what the actual performance is. I will say this became news, I'd say, even outside of the investing world. I saw quite a few people talking about it and messaging me about it. But let me go through what happened in case anyone didn't notice. The Roaring Kitty account on Twitter has resurfaced. It hadn't tweeted in over 3 years, but then just started posting video clip highlights that seemed to insinuate that it was time to get the band back together, which, he didn't directly say, all right, it's time to buy GameStop, but that I think a lot of people could, understand what he was trying to infer there. And I guess as I wrote this, it said the stock was up 150% in the last few trading days, but it's down, what, 30% today? So let me see what it is now in the last 5 days. Only up 67%. Not really much of a meme pump there.
Down
Let's see other
31%
notes.
since Monday. It's Friday close,
Yeah,
I guess.
okay.
Friday close.
Now, I guess the question is, why is he doing this? Is it even him? Is this, just a pump and dump? And I guess what's interesting is someone tweeted about this. There was a case that went to trial of, I'm not going to read this full quote that I took out, but apparently there were these the security fraud charges brought on by the SEC and federal prosecutors about a group of pump and dumpers that used Twitter, Discord, and a podcast to pump penny stocks. The defendants were online nicknames Mr. Zach Morris and Mystic Mac and the stock sniper. And the podcast was titled Pennies Going in Raw, which, got to say, those are, I guess, some aggressive names for all the companies. So the SEC complaint, there were these people that had Lamborghinis. They were saying things like, we're going to pump up money into these penny stocks for the followers. But then in their private chats, they were saying, we're robbing these effing idiots of all their money. So you would think, hey, these guys are going to jail, right? But according to a judge in Texas back in March, so just 2 months ago, the judge ruled that these were not pump and dumps for a strange reason, that they were not directly selling stock to the people that they were convincing to buy these penny stocks. So the pumpers, I think they're free. I don't know what kind of charges they had against them. I don't know anything about this specific situation, but it seems like if you're Roaring Kitty, maybe you looked at this and said, well, hey, why don't I give it a shot? The law has me covered now. But one question I have too, as you guys go into this, is this even Roaring Kitty? Ryan, maybe you go first.
Here's the thing that's kind of interesting. Couldn't those, if they pumped up the stock, the three people in that case, couldn't they may they have been the ones that were selling directly to them? Like, we just don't know who the buyer and sellers were in a liquid market, right? Like, there's a certain amount of shares that are available for sale. They could have been the ones selling those directly to them.
I mean, the judge's
But it's not direct,
not,
right? It's going through an intermediary. So that's the thing.
Yeah, but still, I mean,
that's a fun question.
It is.
Is it Roaring Kitty?
Yeah.
I don't give a damn. I think that's my because it's fun either way. It's fun either way.
And okay,
True.
Here's the interesting thing that I remember reading this from Matt Levine. Memes are difficult to interpret from the law. Like, from a legal perspective, some guy posting someone leaning forward in a chair, if he owns GameStop prior to that, is that him pumping it? He knows what it'll.
It doesn't matter. It doesn't matter, right? It doesn't matter. And Ryan, I encourage everybody to sign up for the Money Stuff newsletter and start listening to their podcast. Don't listen to it instead of investing Unscripted or Chit Chat Stocks. But if you have room for another podcast, add it
make it your third on your list.
There you go. That's exactly it. So I'm not a lawyer. I've never even played one on TV. But here's what I do know about this particular bit of law. This is why penny stock newsletters are legal, but boiler rooms are not. Okay, because a penny stock, I don't want to get into politics here, but the way the government views its role, and I think it makes sense when it comes to law and regulation, is that the government doesn't have an obligation to protect people from harming themselves, but it does have an obligation to protect other people from harming them, right? In other words, a boiler room, when you're actively when you're aggressively calling and actively selling pump and dump stocks, right? That that you bought at a lower price, the asset is useless, and then you sell it at a higher price to somebody to exit the position and make a profit, even though you're selling them garbage, right? That is pump and dump, right? So using social media to get idiots to do dumb things because they don't know better, is it bad? Is it unethical? Sure. Is it potentially some other sort of security fraud? Maybe, depending on the specifics, but it's not necessarily a pump and dump from the perspective of how that has been legally classified, right? I think that's the important thing to remember.
I do think if you are judging your financial decisions off of a meme on Twitter, there may be an element of natural selection going on here.
Yeah, you probably deserve to lose money. Maybe it's the best tuition you'll ever pay in investing, and you'll learn not to do stupid things like that. And you'll find you guys or us or some other reputable source of information to help you actually figure out how to do it well, right?
Yeah, it seems like people pay tuition endlessly though and never learn anything, which is quite unfortunate.
Hey, in their defense,
not the government's job to fix.
They are
Yeah,
crushing
true.
some of my returns so far this year. If you're a GameStop shareholder so far.
Yeah, it seems like it did help a little bit. Yeah, I say my takeaway is people don't. Okay, it seemed to me like there was more like buzz around the anticipation of the return of the meme stocks when in fact it didn't really work this time. Maybe this will, you know, maybe this will I don't know, look bad in a week if it goes into overdrive, but it seems like there was just no one actually cares this time. It was kind of like, oh, it's back. I mean, these tweets were getting like 20,000 retweets, at least some of them, or at least the first one. And yeah, it seems like the the stock's not even up 100%, so it didn't really work as well. I mean, last time, what was it up like 5,000% within a few weeks? And then the second thing is, I think Ryan talked about gut feel. This It feels like a time in the market where people should be a bit defensive, just in general, like defensive in your portfolio allocation.
Yeah, and okay. Last time this happened, I remember thinking there were pockets of excess in the market, right? The GameStop craze, AMC, kind of certain businesses were extremely overvalued. But I kept looking at the market overall and thinking it doesn't affect the big indexes. It doesn't affect the market at all. But I think those little pockets of excess, it should be more of a tell in terms of my internal barometer of where I think the market's at. When we see things like this, where it kind of reaches extreme levels of people punting or gambling, whatever you want to say, maybe it should be a little bit of a cautionary signal.
Three thoughts. Yeah. Three thoughts here to close this one out. There are always pockets of excess. The market is far more healthy and normal now than it was when this was happening back in 2021. People have, and this is tied to that one, people actually have stuff to do now, right? And this is the last one. Besides having fun with it in water cooler conversation and on awesome live streams and podcasts, we should all just ignore the hell out of this. And it should not affect how we invest in any way besides as a cautionary tale that we share with people that are maybe trying to find their footing.
I think that's probably
All right,
the right takeaway.
Ryan. Yeah, that's a good takeaway. I don't, like I've said, I think 3 times already. I don't think anyone really cares this time, and neither should any of the listeners, and neither should we. All right, Ryan, we're halfway through the show. Why don't you talk about some of our friends, our sponsors that help support the show?
Yeah, the first one I'll talk about is Firm Returns. This is a stock research blog that covers equities all around the globe, but leans more towards the UK, as that's the author's home market, and he has easier access to management in that market. There's lots of free content on firmreturns.com, so you can go check it out. I mean, it's got really thorough coverage on niche companies that really are underfollowed elsewhere in the world of equity investing writing. And so some of the companies include Tiny Build, larger companies even, so Warner Brothers Discover, and a lot of really just smaller UK stocks is, I think, where I find the most value in Firm Return service. If you are a paid member, you get 4 in-depth research reports on new companies each year, but there's also an archive of long-form write-ups that you can access for free. So I do highly recommend just checking it out. He, like I said, very thorough. He digs deep into the company's accounts. Some of these are very long reports where he's going through the nitty-gritty of these businesses. And I mentioned it already, but size agnostic. So market caps anywhere from $10 million all the way to $40 billion. So if you want to check it out, firmreturns.com. If you use firmreturns.com/chitchat, you can get 20% off the paid plan. So we like his research, and I highly recommend if you're looking for stocks in the UK market, this is a great blog to look at. Second friend that I want to talk about, you already heard it earlier in the show. You heard us talk about the investing platform public.com. That is where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading, and if you want to see why, go to public.com. OpenAI.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by public investing. Options are not suitable for all investors and carry significant risk. Full disclosures in the podcast description. U.S. members only. Moving on, Brett, any topics that you wanted to discuss this week?
Yeah, do you guys want to talk I called it AI update, but we got I guess it seemed like a little bit of dueling banjos. We had OpenAI say that they're going to do an announcement right around the Google I/O event, and we just got a lot of new products launched as the AI, what is it called? Wars, maybe? I think we can call it the AI wars. They continue, and it seems like, well, there's just a lot more. I mean, if anyone thought it was a bubble at this time last year, just think of all the resources that are going into this. So let me maybe give for the listeners some overview, because I saw a lot of the techie type people on Twitter watching this stuff, but I'm sure not everyone watched these live streams. So we had both Alphabet and OpenAI put out new product announcements. First, OpenAI came out with what they called Chat GPT-4 Omni, which they're calling Chat GPT-4o for short. First off, I got to say, I haven't tried this product, but the name, not good, guys. We need some revisions there. That's a little bit weird.
Too many letters.
Too many letters, I don't know really what's going on. But apparently they upgraded it to make it more conversational and like a voice assistant, but one that's much more smart. So you can talk to it more in a conversational tone, use image capture to explain things, and then it'll come back to you in almost real time and talk to you either through, messaging on a screen or voice, or give you an image or something like that. And then it can also do real-time language translation. With this one, I guess, does this excite you guys at all? Is this one thing when I follow OpenAI is they're very good at, getting their people to understand that their product is out there. But since the launch of Chat GPT-3, I don't know if anything has excited me that's come out of them. I don't know. What you guys think of this? And I should also say, I guess, the day after this, the chief scientist, one of the important leaders of the company, announced that they were leaving. So maybe, I know we got two AI experts here on the call, but Ryan, maybe you want to start?
Sure. First of all, I found it kind of funny that this huge announcement, this Chat GPT 4 it's kind of a weird O. Anyway, these new updates were overshadowed by a guy that posted a meme. It seems like in the news, more people paid attention to the GameStop stuff that day. But I thought some of this was cool. For anyone that didn't see it, there's a basically live translator, which, just to be clear, Google has had that for a while. So I don't know why everyone's treating it like this is revolutionary. But ChatGPT is rolling out a live translator that allows you to basically speak into it. It can interpret it, change it, and it's supposed to help with language barriers.
Most important part, Ryan, it sounds like Scarlett Johansson.
Yeah, it is weird how
that's a win.
Seductive they're making it, but
yeah. They seem to be inspired by the movie Her, which is like a dystopian way that technology goes down the wrong path. And I was like, guys, I don't know if you should be inspired by this, but sorry, continue, Ryan.
Anyways, Duolingo stock actually kind of collapsed a bit on this news, which it kind of reminds me right now of I think it was around like 2015 time period. Basically anything Amazon announced, a whole bunch of stocks in that industry would sell off. Remember that? It was like we're opening a grocery store, and then Target would like tank 10%. It kind of feels
it was a good
similar.
buying opportunity for Target.
Yeah, it feels similar in this case where people think AI is going to crush all these businesses in the short term, but I would be surprised if it really impacted Duolingo's usage.
Yeah,
there are use cases. There are use cases where I think AI will do a good job replacing certain businesses. Customer support's probably the biggest one. So if you have a customer support type business like that Polish company Text, which I could be wrong on this, I imagine it's a big threat there, and it's probably why the stock trades kind of cheaply relative to other software companies.
Yeah, I was gonna say that over the long term, technology is disinflationary, right? We know that because it improves efficiency so much. And I do think, like, when it comes to language software, honestly, I put language software and like the physical fitness industry in the same bucket. Is these things that we get really excited about that generally are crappy investments, because they're niches, right? And we think the TAM is everybody on the planet, and it's not, right? Because the addressable market is always much, much smaller. And I do think if we look into the future decades, the idea of needing to learn a new language is going to disappear because we're going to have an AI in our pocket and in our ear that's going to translate it in real time conversationally, right? And then we're going to speak back to the other person, and they're going to hear, we're going to speak English, and it's going to translate into French or German or whatever. And they're going to hear it in that native language conversationally, right? I really believe that is the future. And people are going to learn new languages because it's interesting, not because they need to be able to do it, right? But definitely in the near term, I think like those dislocations can be opportunities. I have a question for both of you guys, though. This is something we had Simon Erickson from Seven Investing on our podcast a few weeks ago. And I asked him the question, and I knew what his answer was going to be, and I've kind of been thinking that way: is it AI bubble or something else? And he said inflection point. And I think largely I agree, with the caveat that there are always bubbles within every inflection point, right? Because there's no doubt the .com period in the late 90s, we were in an inflection point where so many things were moving to the internet, but we were way over hedging how quickly it was going to be and how valuable those businesses were going to be. So we're seeing that too. So I'm curious, what do you think about that?
Yeah, it's funny. I will say on the internet example, all those people that were called just, oh, you're so crazy for being this optimistic about it. They were right, but just 15 years later.
Right.
Yeah, I think it can be both.
Which, when you're an investor and you're right 15 years early, you're wrong, right? So
Right. Yeah, exactly. Especially if the stock is priced like it's going to be right tomorrow, you're almost
Yeah.
certainly going to be underperforming the broader market. I will say, I think it's likely going to be a bubble or turn into a bubble, but also be an inflection point. I'm not exactly sure, just given the fact that I'm not an expert at all on this AI stuff, how revolutionary it's going to be or in what fields it are, but it feels like there's a lot of meat on the bone here compared to, say, the voice assistant hype of the past, which I never really understood. That kind of flopped. The metaverse was, I don't want to say obvious in hindsight, not going to take off a year from now when we barely have been able to get VR goggles to work without people throwing up. But it seems like there's some, meat on the bone here. And I do not know, I guess, whether we're in a bubble right now. I'd say probably, but it might not matter over the long term. It'll still work. I would trust someone who's followed this more closely and played it exactly perfectly, at least so far, which would be the investor we covered recently. And so he's on top of mind here. Stan Druckenmiller said that he was worried about kind of overheating in the short term with a lot of the AI related stocks. That's why he trimmed his NVIDIA position, which I guess was the deadline yesterday. Maybe I'm actually going to look up how much he trimmed it. But Ryan, what are your thoughts?
I don't really have any particularly insightful take here. I think it can be both, and it probably is both. Over exuberance in the short term, but certainly a useful technology in the long run, and probably will have a massive impact on the world over the next decade or two. But probably a lot of money will be lost in the process from investors. I want to also, there was this question that we didn't get to last week, so I want to make sure we address this, and it's on the topic of Stan
Well, what
Druckenmiller.
about we're on, but let's hit the other part of the segment here with Google's announcements. So we have, I guess, the day after, I believe, of the OpenAI event, which has got to be tough if you're a startup, and then Google's just like, we're competing with you. We can spend $10 million on this event. It's irrelevant to our bottom line, and we're just gonna be, I don't know. That would just be a tough position to be in, where you announce something and then Google's like, no, we're gonna do a product announcement the day after and just crush you. But here are some of the things that they announced at the event. They are embedding Gemini, which is their AI product similar to the ChatGPT type stuff, into Google Photos, Android, YouTube, Google Drive, Google Search, Gmail, and Maps, essentially everything. to hopefully improve those products. The next generation of their TPUs, which is their AI computer chips, I guess would be the layman terms to call them that. That's about all I know about them. But they're coming out, and the key is they have 4.7 times, so basically 5 times a performance boost from the prior generation, which is an advantage they have versus any other competitor that, they can either have these TPUs or sell them on the cloud. They came out with an updated Pixel phone and Pixel tablet with AI embedded stuff. It looks like they copied OpenAI's video generator, excuse me. And this part, which I think was underrated, was announced at a different time. This seems mildly useful to me. Quote, in a paper published in Nature, we introduce AlphaFold 3, a revolutionary model that can predict the structure and interaction of all of life's molecules with unprecedented accuracy. And I'm missing a lot too. I probably about half the things in here. The question I have is there a single company in the world that can compete with Alphabet in AI? Because I honestly think they're in such an advantaged position.
In what way? Distribution?
Just holistically, they have the computer chips that they've spent a decade on. That is way an advantage. They have the best AI research team that's way ahead of. I mean, there's not a single company that could have come up with this protein and molecule prediction thing. They have the largest distribution of users of okay, they can basically say, we come up with this AI product and we can immediately get it to every single person in the world through multiple touch points. Google Photos, Android, YouTube, Google Drive, Google Search, Gmail, and Maps. Some companies have part of this, right? On the distribution part, Meta has that. On the cloud part, Microsoft has that. But they don't have it on the chips. They've been way behind on that. I don't think any company has the combination here.
I disagree. I think Microsoft, as an investor, they have a much clearer path to monetizing it. Alphabet is positioned to continue collecting data to grow it, to potentially make it better. But I don't know that it really creates value when you're selling ads, right? I don't know that it's an incremental boost to the bottom line like it is for Microsoft, where they can go to large enterprises and talk about building AI into their existing tools for eventually a premium price, because it helps those enterprises become more productive. So that's my one question there. And I have a sleeper for you guys. I have a sleeper, Apple. And the reason here's what, no, let me tell you why.
Okay,
let me tell you why. Who had the first smartphone? Well, it was not Apple.
Not Apple.
No.
It was Palm, right? Or
The
am I
Palm.
getting that wrong?
Yeah, the Palm.
Yeah.
And then the BlackBerry was dominant, right? Who had the first MP3 player? Wasn't?
No clue.
We're too young for that.
Well, I mean, that's kind of the point, right? Apple has this history of almost never being the first mover, but they're really damn good at perfecting it. And I think we're sleeping on their ability to develop, because they're probably working on a lot of things for AI that we don't know about, that they have not brought to market, because they don't move fast and break things in public, right? So I think we're sleeping on Apple a little bit to potentially do a lot more with AI than maybe we're giving them credit for right now.
Yeah, I can buy that argument. I understand that in the past they've done this where the research is tight knit. They don't pre-announce stuff. They wait till it's really polished. I would say, has that changed with the Vision Pro? I don't know. I would worry about that maybe a little bit, although that's obviously just one product. But I think, and yeah, they have their product announcements. I think they do one in June, right? And then one in September, if I'm remembering correctly.
Yeah, that's about right.
If that is underwhelming this year and they don't come out with anything, I would say that they're clearly behind.
Yeah, I'm not going to argue that even a little bit.
But I guess we don't know yet. So I guess, yeah, that is fair. Maybe they're under the radar for a reason, because they always stay under the radar. That is a good point. Let me just look at, okay. I guess I'm going to use this as a way to toss in a advertisement for our friends at FinChat, but I think it'll be a fun one. I have the KPI. I'm going to load it up here. The KPI of Alphabet's Google Cloud revenue. Now it's gone from 4 billion in December 2017 to 35 billion over the last 12 months. If you look at quarterly, it's basically just climbed. There's really no slowdown except for that one period at the end of 2022 when all of the clouds slowed down. 36% growth rate on the revenue side, and margins are finally starting to show up. It feels like with they have the chips here, they have their internal development where someone like DeepMind can get a huge amount of spend there and hopefully eventually get some good returns. It feels to me like Google Cloud. It's hard for me to imagine it not being $100 billion business one day, given the fact that they can sell to third parties. A lot of the AI tools they develop, they can control this as well. And with the TPUs, along with NVIDIA, they have the cheapest option for a lot of these people that are searching for AI spending. And I guess that what's funny enough is, one of the AI companies is one of our sponsors, FinChat. So let me just talk about them. I guess I don't have the show notes. Ryan has a leaf blower going in the background, so he's on mute right now. But basically, if you can see those charts, if you're on YouTube or Spotify watching the video, you have all these fantastic KPIs that they make for you for all these companies. And it saves me just researching for the show, researching stocks for my own app. So, we just did a show on Portillo's, and the KPIs they make there save me so much time for my own research, and it helps me become a better investor. It helps me be more efficient, and it can give so many useful insights, plus a lot more. They have their AI Copilot that they're working on as well. So go ahead and check them out. The link will be in the show notes. Use our link, and you can get a 15% discount on any premium plan. Go try it out, though. You can try it out for free. So it is a freemium model. And if you sign up for the premium plan, you help out us a lot as well.
Paid plan, just to be clear.
Paid plan.
Because there's premium and
plan,
pro.
Professional plan, whatever they're called. Either way, if you sign up, I don't think you'll regret it, and it helps us out a lot. All right, we got about 10 minutes left, I would say.
Let me chime in. Let me
Ryan,
chime
you
in because
you had that question from last time.
Yeah, and I apologize in advance because there's a leaf blower right outside my building. There's a chance he starts to just make a lot of noise here in a second. So I'm going to try to answer this as quickly as I can, say my piece, and I'll pass it to you guys. Firm Returns asked us this question, I believe, last week, and we're getting to this now. He says, do you think it's possible to make a bet on a single stock like the famous currency bet discussed in Wednesday's podcast? By this, I mean 2 times levering your whole portfolio because you perceive the downside to be so low. What he is referring to is Stan Druckenmiller's currency bet. The answer here is no. I think that would be incredibly irresponsible and a bad idea. The reason I say that, the perceived returns were so low in Stan Druckenmiller and George Soros's case because there were no other sellers of the pound. The Bank of England had to buy from them. So there was literally like pretty much guaranteed really low downside. With any stock in any liquid market, it's probably unlikely that you're going to have something that illiquid where the downside is for sure that low. So no, I never recommend 2 times levering on any individual stock unless you have some way of guaranteeing low downside. That's my answer. Thoughts?
Yeah. 2x levered. Yeah, of course, for a stock, probably wouldn't want that. But I'd say for me, let's say you've been following Berkshire Hathaway a long time, and it's 40 years ago, and it's in the 90s. They're in such a good position. They have shown that they have a phenomenal track record. You're confident in the management team. You're blah, blah, blah. Everything checks the box, and it's a diversified conglomerate. I would not, if someone said I'm making that 50% of my portfolio, I don't think that's a crazy idea. But that is a unique situation. I also don't think it's crazy when, in the David Gardner approach, something becomes a large position in your portfolio, where I think he's mentioned times before Netflix turned from a small position, was this huge winner, biggest winner he's ever had, and it turned into a large position just because he hasn't sold it. I don't mind that approach either, but for a stock, say, like a Netflix back in the day, if you were going to make that anything more than, I don't know, if you were going to make that 50% of your portfolio, that is taking on too much risk, because the downside of Netflix back in the day was high. And yes, it did work out because there's a lot to that history, but there was a lot of risk there. So I think the downside is what's important for me in differentiating whether you should, size up a position and not be uncomfortable with it.
Two observations. The biggest losses investors end up incurring are almost always the sure bets. It's almost always like there's this little niche, there's this opportunity, there's this thing, and it's never a sure thing, right? And secondly, this is the second observation. It's one thing to make a big bet long on an asset that goes to zero where you lose 100% of that investment. But when you start factoring in leverage and you start dabbling in things you don't really understand the mechanics of, like foreign currency markets and futures on commodities, that's when you can end up losing everything and owing somebody money, right? You can not just go to zero, but you can go negative, right? We're talking about, that's why Warren Buffett is called, some of these different, what do they call them? The mortgage-backed securities, like these different security things, financial weapons of mass destruction. Because when you invest in things that are complex that you don't understand, and then you compound the risk with leverage, you're not just shooting yourself in the foot, you're sawing your leg off, right? So I just really want to encourage people, don't invest in things that you don't understand that somebody tells you is a sure thing.
Here's the other thing. Even if you were right, like even if it was this, it's going to work out type investment, for sure, you've done all the research in the world. First of all, the future is always uncertain, so there's a chance that you could be wrong. But let's say you were for sure right. You also, once you introduce leverage, have to be right on the timing, because it doesn't matter if you're right in 15 years or 10 years, you have certain interest expenses that you have to pay that are not waiting 10 or 15 years. So it reduces your time horizon, and it significantly enhances the risk beyond just potentially owing money. You not only have to be right, but you have to have the timing right, which in equity investing there's so many factors that could impact the result in the short run that have nothing to do with the performance of the business.
You're throwing all of your advantages as an individual investor out the window.
Exactly.
Yeah, I agree. All right. Firm Returns had another question on Disney and Warner Brothers Discovery earnings. I'm going to say apologies to our friend and loyal listener, because we'll probably save that for another time. But I did tweet out, did anyone have any questions tonight? I think this is a good one to close it out on. Cardio Capital says, in a frothy market with high valuations across the board, he says, okay, across the broad market, where do you feel like the greatest pockets of opportunity currently lie? Anyone want to go?
Home builders.
Ryan is on the home builder train. I understand. Hey, we did do a podcast on them, I believe, around 2 months ago. People should go check that one out. Jason, any sector of the market that looks interesting to you?
Yeah, just to put up something different, I'll say banks. There's still a lot of banks that are trading, especially moving away from like the big four and looking at like some of the larger non too big to fail banks and some of the regional banks and some of the online banks too, like Access Financial, I think is just, people are missing the boat there. And Live Oak Bank shares, massive fan of. It's almost like thinking about like the commodities and like some of those short-term things. You have to be long, like multiple year long, because of the cyclical risk. But I think they're great underappreciated assets right now, and a lot of them are cheap.
Yeah, I mean, you could have some, 1x book value, 10x earnings, and they've had historically 10% plus ROEs, return on equity, which that's a good recipe for a bank to do well.
Yeah.
Yeah. What about you, Brett?
Pretty simple from there. For me, I think small. I wouldn't call it small cap value, but maybe just small. I know some of them I've ripped recently, but I think this is a good time to check out Value Investors Club to look at some smaller pitches, because I've seen a lot of stuff that looks, not everything's gonna I don't know, look sexy to me, but there just seems to be more opportunities there where I'm like, okay, this could make sense. The numbers could work here. Whereas opposed to I look at the Magnificent Seven and I go, a lot's got to go right here. Where what's interesting is 18 months ago, it was almost the opposite. With stuff like Amazon and Alphabet, I was like, it's hard for me to argue I should go anywhere besides those two when they're trading at, I mean, Amazon wasn't trading at 15 times earnings, but you kind of look forward and say, if the margins do anything, we could be at 15 times earnings. And you look at that and you're like, okay, seems like a low risk given their competitive advantages versus the potential returns we get at these low valuations of probably the lowest they had been at of the last 15 years. But today, I think it's the opposite, where it's a perfect time to look at some either beaten down or small cap value type stuff or anything smaller that's getting underfollowed, because it seems to me, and Jason, you do work for the Motley Fool as well. I like to use that as an indicator where the trending stuff there is all large, it's all mega cap, and it's all NVIDIA, it's all AI. And as much as I appreciate getting bonuses writing those articles, it shows to me that the opportunity might lie somewhere else at the moment when you're trying to find a new stock for your portfolio.
A lot of times it's not where anybody's looking. I agree with that. I will say this though, just real quick. So Amazon trades for less than 20 times operating cash flows right now.
There's a lot of CapEx.
Yeah, I guess
there's a lot of CapEx, but it's coming down. It's coming down, but it's true. It's true.
That is.
But
true.
the other thing
that
with their CapEx is we've talked about this on the show before. If they're if they're raising their CapEx, it's for the AWS side of things, which I think makes up about 50% of their CapEx.
Yeah.
It's because they see the demand coming. So they're just doing it in advance.
Right. Yeah.
Yeah. And I would be worried a little bit about, similar to the fiber overbuilds of the dot-com bubble, I would be worried about an AI overbuild for these cloud providers, because they all seem to think there's zero downside right now and just build. But who knows? I'm no cloud expert. All right, we're on the hour and 2 minute mark here. Jason, appreciate you joining us today. Why don't you tell all the listeners, I know we only have a few people joining live right now, but there will be a lot more listeners on the actual show when it comes out on Sunday mornings. Tell us anything you want about Investing Unscripted and what you and Jeff do over there.
Yeah, so we'll start there. Investing Unscripted podcast. You can find us wherever you get your podcasts, Investing Unscripted. We do a newsletter too, investingunscripted.com. We drop a newsletter every Sunday. Just thoughts from either Jeff or myself, completely free of charge. We also release a transcript on Wednesdays when the podcast comes out. And we have lots of links in the transcript. So if you're looking for stuff that we talked about, makes it easier to find your links. We also recently, because we don't talk a lot about individual stocks on the show, it's like one of the differences between Chit Chat Stocks and what we do, a lot more mindset stuff. We decided to start up a Savvy Trader portfolio and really kind of build our own portfolio working together, create a separate space to talk stocks and to talk process. That's easy to find at savvytrader.com/investing unscripted. If you want to check that out, you got to pay for that. So there's that. That's basically it. You can find me on Twitter. You find these guys, you'll find me in the comments. So makes it pretty easy.
Yeah, I'm loading up the show list. I did have this one downloaded already. 3 things to know before buying your first or next stock. I think it's a good combination of, you've been doing this for a long time, and Jeff has only started, I think, 5 or so years ago with investing in individual stocks.
Right.
Where you're if someone's just getting started, and you think some of the stuff we cover on Chit Chat Stocks, sometimes we don't try to go through the basics of everything. This is a perfect show where you get back to the basics, you learn the concepts of buying individual stocks, and there's just a lot of stuff that you can learn of, and a lot of the same feelings I think a lot of investors have when they're first starting out,
right,
that you guys talk about, and it can be a great sounding board. And you guys do a ton of listeners submitted questions too to help with that, right?
Yeah, about once a month we do a mailbag. We're pretty active on social media too. Always enjoy doing that. And we also do a live stream once a month as well too. So
beautiful. All right, so go check those guys out. Maybe I can just hit the disclosure this time. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I Jason, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone who tuned in on the live stream. We know we have a few that ask questions, but they're always good. That is at 9:30 a.m. Pacific time and 12:30 p.m. Eastern time every Thursday on the Chit Chat Stocks YouTube channel. If you want to join live and ask questions, you can do that, but you can also listen to the replays on YouTube, Spotify, Apple Podcast, wherever you get your podcast. Thank you, everyone, and we'll see you next time.